Lower dollar frees up global balance sheet capacity, also increases global growth by lowering the real global dollar debt burden. And so that can be absorbed more. But lower dollar also risks higher inflation. So we lower the dollar that much, inflation's going to pick back up, particularly import inflation. And so it buys you time that 5% plus 10-year yields don't blow you up on one hand, but on the other hand, they blow you up 3 to 6 months from now when inflation picks back up because of the weak dollar. And so it would only be a stopgap if you weaken the dollar and let yields go that high. Ultimately, the only way out of this is massive productivity boom that does not drive employment up by more than 4 or 5%, highly unlikely, in the short run, or devaluing the debt. You got to devalue the debt, and that's yield curve control, much more explicitly in some form. And that's good for gold. It's good for stocks. It's bad for the dollar. It's good for inflation. It's good for stocks in dollar terms. It's bad for stocks in gold terms. You've talked about Japan being the catalyst for quite a while now. Do you see this as indisputable evidence? And at what scale will pending interventions need to be ramped up? And what are any potential implications? In short, it's further confirmation that net international investment position that we've been harping on matters. Nobody is short dollars. They're not. They're short dollars on one hand, no question. But they're long U.S. dollar assets on the other. And either the U.S. supplies more dollars or foreigners will sell dollar assets, starting with treasuries, to raise dollars. And that will knock stocks down. That will knock bonds down, yields up. Wash, rinse, repeat. That threatens the United States. That threatens Western solvency once Western sovereign bond yields hit a certain level that is quote unquote too high, as we've referenced it. And so the implications of this are that we're on the path towards explicit yield curve control. Unless we get off that path, which would require us to allow bond yields to rise and rise and rise until they find their level, even if it forces U.S. and Western sovereign defaults, and that is, in my opinion, never going to be allowed. And importantly, Warsh 2-3 weeks ago said to Congress that I'm paraphrasing, but he said he is going to stand back and intervene less, except when there's a crisis, in which case he may need to set a fair price for assets. Translation, he's going to intervene in the Treasury market when he needs to, just like Powell, just like Bernanke, just like Yellen, just like all of them. Okay, back to the point, which is if we can assume safely, which I think we can, that Western nations are never going to allow sovereign bond yields to rise to levels that threaten defaults, nominal defaults in Western sovereigns, then don't be surprised when we arrive to our destination, which is much more explicit yield curve control. And so fundamentally very good for gold, very good for stocks in dollar terms. Eventually, I think it's going to be good for Bitcoin as well. I think we've got to work through this sort of the aftermath of the Bitcoin civil war around BIP 110. And also for tourists, I think the cold card implications are still a little disconcerting. And I would say, too, and it needs to really diverge from tech. It still has not diverged from tech. So next question from David. What are the implications of the U.S. selling euro to support the yen? How fragile is the system? I don't think there's much in terms of implications from a tactical standpoint. Markets have already reversed much of the move because, in the grand scheme of things, it was a drop in the bucket. From a signaling standpoint, I think Bessent's goal in doing this was that he hoped that hedge funds would join him and front run him in selling the euro to support the yen. Works two ways for him. It pressures the Eurozone, and it supports the yen. As I put up a post on X, why does the yen need supporting? In no small part because the Trump administration put a bullet in the yen by the trade war and the invasion of Iran, inflating Japan's oil bill. That's neither here nor there. I do think that Bessent, excuse me, was trying to have hedge funds front run and join him on the trade, a la 1992 pound, perhaps. But the effects of his intervention have already been mostly unwound. Bigger picture, I think it's a big signal. in that it is the first U.S. official intervention in the yen, I believe, since 1998. In my opinion, it will not be the last intervention. We can see it's not working, so they're going to need to do it again because nothing else has changed. The factors that drove the need for a intervention are all still there and getting worse. So Besant's going to need a bigger boat, as Roy Scheider said in Jaws. Okay, from Chris. Are you concerned that as this K-shaped economy plays out and the required fix that involves very big inflation takes place, there will be a pitchforks and torches moment? If you're correct, and you are, thank you, I hope we are, your subscribers will be rich. Should they worry about becoming targets? Am I worried about a pitchforks and torches moment? Yes. But I think I'm not worried about it nationally. I'm worried about it more regionally and locally. And I think that's something people can kind of pay attention to and decide. But it's not a huge risk, a huge worry. I think it's a risk. I don't think it's a huge worry. Other than certain localized areas, I think it's going to be more sort of creeping, just creeping more of like what we've seen over the last several years. Now, I will say history has been pretty clear on how record wealth inequality and elite overproduction plays out, right? In the End Times book by Peter Turchin, he lays this out pretty clearly, and the U.S. is in a position we haven't been in since the late 1850s, according to Turchin. So the tinder is in theory there. It has the risk of not being pretty and me being totally wrong that there is something to worry about, but I think we still have time. It's part of the reason why I speak up so much, that we need to make wiser choices. We need to be than we're making from a policy standpoint. It's a big part of why I was so against this Iran war. Is it just doesn't help. It doesn't help America at all on this front. And so it's one of these things where we really do have to sit around and say, let's watch and pay attention and adjust course as we may or may not need to. From Oliver. You've talked about there being a moment when Warsh needs to show his cards, and you're waiting for the elites to signal they're going to print money. Is there an alternative situation where we can just get a gradual debasement versus a COVID version 2.0? Can this just be a slow train of currency weakening, or mechanically, do we need the V rocket ship? The pace of debt expansion and the true interest expense already being at 100% of receipts, interest, entitlements, veterans benefits, suggests that the longer they wait, the more it needs to be a rocket ship. An example I go back to is after World War II, we saw debt to GDP go from 110% to 55% in just 5 years. How'd we get there? Negative 13% real rates at the lows, capital controls, and significant growth, rebuilding. We were rebuilding America. We were rebuilding the world, rebuilding America after the Depression, rebuilding the world after the war. So I said, okay, let's assume, I ran this math in early 21, maybe April 21. Let's do the same thing. Let's take debt to GDP from 120, 130% down to 70, 80%, because that 70 to 80% was the last time the Fed could raise rates without pushing the U.S. into fiscal dominance and triggering Treasury dysfunction. So I said, let's let that be our goal. And then back into what type of negative real rate we need to achieve that number, to go from 120 to 130% debt to GDP down to 70 to 80% in just 5 years. And we're going to keep growing debt to GDP by 8% per year, as it has every year on a compound annual growth basis, CAGR basis, since 2008. And what we found was that the U.S. would need to have negative real rates of anywhere from negative 12 to negative 16% for 5 straight years. Maybe 3 years, maybe. And now you see why it's going to have to be a big rocket-shaped V. Because no one's going to sit around in negative 12 to negative 16% real rates for 3 to 5 years. Then you might actually get torches and pitchforks. So you're going to have to do it fast. And you're going to have to do it to the people that can afford it. Well, what would that look like? Well, to me, if they said, Luke, who would you load up on long-term treasury bonds before you did it real fast? I said, oh, that's easy. I would load up the banks and I'd load up the boomers. The banks we bailed out, they owe us anyway, and the boomers, they're not paying for what they're using in terms of services. It's just a tax hike on the richest generation, on the wealth of, or a tax hike on the wealth of the richest generation in human history. I'm sorry, I know it's very K-shaped within the boomers. I'm just saying that's how I would do it. And to my eyes, forget about what I think. Who's been the biggest buyers other than the Fed of U.S. Treasury bonds over the last 5 to 8 years? Banks, boomers. So they're set up for it, and the math suggests it can't go slow. It has to go fast. So the $64,000 question, as always, is when? Could be next week. Could be 5 to 10 years. I don't know. I'd be surprised we can make another 10 years given the math. The math ain't mathing already, and we're already at 100% true interest expense. But they've managed well, all else equal. Maybe they can keep doing some rolling things like this. But that's the nice thing about informs my allocations. I don't know, and so where am I? I own a lot of gold. I own a little bit of Bitcoin. I own a lot of cash because I don't know. I own in infrastructure equities, big. That is it informs my positioning. And the final question from Florida: if the 10-year yield rises to 5% plus this year, what are the consequences? It depends on the level of the dollar were that to happen. In a vacuum, if the dollar's still trading wherever we are, 9,900 Dixie, DXY, 5% plus is a big problem. That is a big problem. You get a much lower dollar, Dixie, I don't know, 92, less, maybe even 94, 96, maybe 5% is less of a problem. Lower dollar frees up global balance sheet capacity, also increases global growth by lowering the real global dollar debt burden. And so that can be absorbed more, but lower dollar also risks higher inflation. So we lower the dollar that much, inflation's going to pick back up, particularly import inflation. And so it buys you time that 5% plus 10-year yields don't blow you up on one hand, but on the other hand, they blow you up 3 to 6 months from now when inflation picks back up because of the weak dollar. And so it would only be a stopgap if you weaken the dollar and let yields go that high. Ultimately, the only way out of this is massive productivity boom that does not drive employment up by more than 4 or 5%, highly unlikely in the short run, or devaluing the debt. You got to devalue the debt, and that's yield curve control much more explicitly in some form. And that's good for gold. It's good for stocks. It's bad for the dollar. It's good for inflation. It's good for stocks in dollar terms. It's bad for stocks in gold terms.